Welcome to the All Financial Hour podcast with Steve All.
You know, now that President Trump is back in the White House, what will his influence be on the stock market? Well, economist and market analyst Stephanie Pomboy tells Fox Business that he's inheriting a very different economy this time around.
In November 2016, when Trump won, the S&P 500 had been flat for over 18 months. It had gone nowhere. That's in stark contrast to today, where we're talking about gains of 30% over the last year in the stock market.
All right, so Steve, let's talk about this. I mean, are you approaching this year different than you have with your clients in the past? And is it still, we're always cautiously optimistic and playing the defense? Talk to me.
The idea right now, it's always the markets are up, the markets are down, or they're going to stay the same. That's about the only guarantee that we can give. So it's usually a little bit more difficult when people come in and sit down and talk with us when markets are up. We've had 2 good years in the market. So people look at it and say, well, I'm doing okay. I might not need any help. And that's where we have to look at it and say, okay, what kind of return did you get? How much risk were you taking for that return? So that, I think, is the most important thing that we look at. I want the best return I can get with the least amount of risk possible. So how do we do that? We use Market Guard, proprietary investment philosophy that uses non-emotional, methodical, mathematical approach to investing. It gives us those signals that most people are actually looking for. I get asked all the time, Steve, when do I hold? When do I sell? And if I made that decision to sell and pull back, when do I reinvest again? And I think that is the biggest question that most people have. Because like I said, we usually say we want to buy low and sell high. Well, where are markets at? Is now the time to take a little bit of that off the table? It's always funny when we ask the risk reward. On a scale of 1 to 10, where do you fit on that scale? 0, I'm as conservative as you can be. 10 is I'm as aggressive you can be. It's amazing when markets are up like they've been for the last 2 years that I hear the 7s, 8s, and the 9s. When the market fell 3 years ago, guess what you hear? 4s, 5s, and 6s. It's people are more conservative when the markets are negative. They feel better when the markets are positive. So the idea around it is, should your portfolio be in all the exact same thing? My deal is no. I'll get asked, what should I buy? I said, give me the time frame, give me the amount of money, and give me the titling. Is it a non-qualified or after-tax money? Is it traditional IRA or is it Roth IRA? And how much do you have? I think those are the things that we need to look at to actually build an investment portfolio for people. Because I believe that retirement's not a destination. It's a journey. Grow and protect a tax-smart portfolio is our goal so that you can enjoy your retirement.
We have talked plenty of times about this idea of converting money from your 401k to a Roth, but it brings up lots of questions. If you convert money while you're working, Steve, you could eventually be thrown into a higher tax bracket. But if you wait until your income is lower in retirement, the conversion could result in high Medicare premiums and then more taxes on Social Security. I mean, what is going on here? How do you arrive at the right timing?
Well, that's the big question. That's the $64,000 question. When is the best time to do it? Because Roth conversions, I believe reducing or eliminating taxes in retirement is the greatest thing you can do for successful retirement. But you just mentioned some of the roadblocks that we have to look at. Some people will say, I can't do Roth conversions because it'll make my Medicare premiums higher. And then I go out to when they're 73, 74, 72, depending on their age. Well, look at your income at this time. Your Medicare premiums are going to go up just because the RMDs you're going to be forced to take. And the big thing about it is they're probably not going to go down. And do you think Medicare is going to be more expensive 5 to 10 years in the future or less expensive? So that's one of those ones where we have a catch back and forth. The Medicare catch also has one other thing to it. They always look back 2 years. So if we looked at a program and Roth conversions might have been smart for you, it might affect your Medicare premiums if you're married, for you and your spouse, for the number of years that you do it, because they always look back 2 years to figure out what your Medicare premium is. Right now, tax brackets. We've got the 22 and the 24 that go up quite a bit for everybody. I believe that they probably won't get a permanent Trump tax cuts to be permanent. I think they'll have to do it the exact same way, and it'll sunset in the future. But I went from having to talk to people about having 1, 2, 3 years of lower taxes to I believe we're going to have 6, 7, 8 years worth of lower taxes. Mm-hmm. And I think that gives people a lot bigger window when they start to look at those IRA assets for Roth conversions. Because 10 years ago, the best asset that we could pass on to our heirs was our IRA accounts. Why? They could defer it through their lifetime. They had to take a minimum distribution. So they'd take small amounts, and then maybe when they quit working, they could pull off a mom and dad's inherited IRA. But in 2020, they changed that. And they said, now it's got to come out in 10 years. So I believe that the IRA account, it could be the least desirable asset to inherit, because you have to pay the taxes on it in 10 years. It's not a spend. You just have to pay the taxes on it. So when people look at that, passing a tax time bomb onto our children is a problem that I think that we currently have right now. And I get people that'll come in and say, Steve, I wasn't planning on leaving the kids anything anyway. And I said, would you rather leave it to your kids, or would you rather leave it to the IRS? Thank God I've never had anybody that said I'd rather give it to the IRS. So having too much money in your IRAs and 401ks can subject you to tax rate risk in the future. What do I mean by too much? The average IRA 401k is about $178,000 to $180,000. So if you've got an extra large between $250,000 and $750,000, depending on your pensions and your Social Security, you might spend those assets down during your lifetime. If you've got a double X between $750,000 and $1.5, chances are you're not going to spend down all those assets. So you're probably going to pass a tax situation onto your kids. And if you've got a triple X, 1.75 or above, you are going to pass a tax time bomb onto your kids.
Something else a lot of folks are watching are the interest rates. They have come down just a little bit, and also the rates on annuities have come down. So they are not as high as they were last year. But Steve, I really think the question is, should we be buying annuities in 2025? Is there still a great benefit there? What are your thoughts on this?
I think the right tool for the right job, and that's for me. I don't dislike annuities. Sometimes I like annuity salespeople where the people aren't getting what they actually need. So there's the question that I have. If your guaranteed incomes, Social Security, if that's all you have, Social Security and pension, if that's not meeting your monthly lifestyle expenses, there's a gap between those two. And one of the ways to fill that gap is an annuity with an income rider. And if I can fill that gap with a small portion of your assets, that I know it's going to be there, that insurance company is going to guarantee that payment for the rest of your life. And if you have a spouse, your spouse's life, I think that's absolutely wonderful, right tool for the right job. Right now, interest rates have come down a little, but they're a lot higher than where they were 4 or 5 years ago. So we've had the availability to have somebody that has an annuity with an income rider that they haven't turned the income on yet to actually come in, sit down, let us do an x-ray. We'll call the company that you currently have it with, find out what kind of income that you can get, and see if that can be improved upon. You might have to accept a longer surrender charge, but if you're turning on a lifetime income, I don't see that as a negative benefit.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group LLC.
This radio show is intended for information purposes only.